Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies and their SOFI stock, ticker name SoFi. In this video, we will be discussing why SoFi stock is downtrending right now and pulling back after their phenomenal earnings report. After that, we'll talk a little bit about how SoFi Technologies has a great catalyst to where they have now paired with Expedia, giving people access to discounted travel regarding the ability to book flights, hotels, car rentals, and more at a phenomenal discount. And it seems that this catalyst has somewhat gone unnoticed by investors because people are more focused on the overall share price decreasing, which we will also talk about why that is in our first article. After that, we'll discuss why an analyst has decreased SoFi Technologies from a buy rating down to a neutral rating, and we'll be discussing the latest price targets and price predictions for SoFi Technologies to determine whether or not this is still a good company to own in your overall portfolio. Lastly, we'll be going over the pros and cons for this company, whether or not you should buy it as an investor, and how much risk you are taking on. But overall, it seems that SoFi is well positioned because there is phenomenal news coming out right now, despite the overall share price decreasing. So for more videos just like this one, don't forget to go and annihilate that like button right now. Literally, go ahead and smash it because it helps me so much. Don't forget to become a member of this channel for just 99 cents. You can support me personally so I can continuously make videos just like this for you. Go ahead and comment your thoughts down below about why you think the SoFi share price is falling right now and where you think it's headed in the future. Subscribe for more videos just like this one, and without further ado, let's jump right into it. SoFi Technologies is a neobank or a fintech company that essentially operates as a digitalized bank, and SoFi Technologies, ticker symbol SOFI, brought in very strong Q1 results for both earnings and revenue. However, this seems that it didn't help the stock too much, regarding that we saw a pre-anticipatory run-up by around 25% from the beginning of the year until the earnings report, and then after the earnings report, we have had 2 consecutive trading days of the company falling in price by approximately 21%. So we will be consulting an Oppenheimer analyst to discuss exactly why the share price is falling. And the analyst says that the key issue this quarter, in our opinion, is the loss of a tech platform partner that has moved the Galileo accounts down 3.8% quarter over quarter. He goes on to say, the stock is likely reacting negatively because of guidance that's going to be flat for Q1 of 2023 in regards to their technology platform segment over the next 9 months pertaining to the revenues. He goes on to say that SoFi had a terrific quarter and is executing extremely well. So well that they keep absorbing various revenue headwinds while raising guidance. Given the sell-off, we again see limited downside to shares. So what does all this mean? Essentially, the analyst is saying that the decrease in their overall share price has nothing to do with the company fundamentally in regards to their earnings per share or their revenue. This only has to do with their technology platform regarding how their Galileo platform lost a major customer. Luckily, their technology platform doesn't make up a lot of their overall revenues, and it's their lending segment that brings in the majority of their revenues, bringing in hundreds of millions of dollars. So despite this, the analyst also says that even though the shares are decreasing in their overall share price, it means that this company has a limited downside or limited risk of future potential losses, and right now could be an amazing buying opportunity. This analyst even reiterated an outperform rating, which is a buy rating for SoFi shares, and he believes that they are at least worth $7 over the next 12 months, implying approximately 28% upside potential for investors who buy right now. But he's not alone in this, because other professionals, experts, and analysts who have commented on SoFi are very bullish and positive. For instance, out of 6 analysts who cover the stock, 5 of them say to buy the company and 1 of them say to hold, and we will discuss which analyst says to hold literally in this video. I also want to bring to your attention that none of these professionals say to sell this company, and the majority of them say that this sell-off is overblown. The average price target for this company stands right now at $8.50, meaning that there is potential for this company to surge as high as 73% higher from their current share price of around $4.92 up to $8.50. But that's not even the most bullish prediction. The most bullish positive prediction is actually $10 per share, meaning that this company has loads of upside and could literally double your money. For me personally, I would agree with this particular analyst. I think the company is most likely worth between $6.50 to $7, and I do believe they are going to achieve that by by the end of the year, especially once this company becomes profitable. So now that you are informed about why the shares are dropping, and it has nothing to do with their earnings or revenue, and it's mainly due to their technology platform losing a customer, let's talk about a catalyst that not many people are talking about right now, and that's how SoFi Technologies is rolling out a partnership with Expedia, which is going to offer SoFi members the ability to book flights, hotels, car rentals, and many other things at a discount. I also want to make you aware of this phenomenal interview that I will link below that you should also watch after this video, but we're going to go over some key things that were brought up in this video that I think will be very helpful for investors. So take a listen.
Anthony, they're worried about your forward-looking guidance on EBITDA growth. And is that competition in any way? Because you have a banking license, but a lot of the other online lenders, neobanks, they're doing well with just banking partnerships. What do you make of the space you've made for SoFi when the market is worried? Or maybe it's just profit-taking?
This interviewer is concerned about the future EBITDA growth projections regarding SoFi. However, I do want to say that she rightly highlighted how SoFi is very innovative and does have the technological advantage compared to their neobank and fintech peers, because SoFi Technologies is literally an actual bank and they don't have to rely on third parties for various banking operations, giving them a huge technological and competitive advantage in this regard. And this is the CEO's response to the interviewer's question regarding EBITDA.
We raised our outlook, actually. We increased our revenue guidance for the year. We also increased our EBITDA guidance for the year and reinforced our view that we'll be GAAP profitable by the fourth quarter. Our bank, which is a subset of our overall company, is already GAAP profitable, and we had really strong margins there of 20%.
Isn't that absolutely amazing? Their banking segment is already profitable, meaning that it's only a matter of time before the entire company becomes profitable by the end of the year, which will cause the overall share price to radically increase. And this will naturally only be possible if EBITDA actually increases as well, which was his main response. But I also want you to hear directly from the CEO and another interviewer about their partnership with Expedia.
Anthony, let's go back to the travel news. Is this you trying to win business from American Express and the Chase card business?
So this guy is mainly saying, are you just trying to compete, or is this actually going to be a good move by expanding SoFi Technologies into other segments, because you don't want the company to be spread too thin by biting off a market share that's larger than the company could chew? However, I do really like the CEO's response to this, and he says,
SoFi Travel with Expedia to give our members great value in their travel choices, great selection, great ease of use, and most importantly, great prices. Prices that are even better when they pay with SoFi and they use their reward points and they actually generate reward points with us. So we're providing what they could typically get someplace else at an even better price, so they're spending better with us.
Overall, I think that is a phenomenal thing to do, to branch out into other market segments to bring in not only more revenue, but also support specifically SoFi members. You're giving SoFi members a huge discount, thus increasing your competitive advantage in this particular space. And that's not all. The CEO also says that in the future, they are looking to infiltrate and integrate themselves into other segments. So just take a listen to this.
We'll look to do this in other categories like entertainment, and other types of things like sporting events, etc., that are high ticket purchases.
This is very good, and I like to see a future growth runway and trajectory regarding how this company will evolve and build shareholder value over the long term. So overall, if you want to hear more of what the CEO has to say on this interview, I will link it down below in the description. But now let's move on to our next story regarding why a particular analyst from Wedbush has decreased his overall price target down from a buy rating to a neutral rating. So let's see what evidence he gives for this. Essentially, due to the decline in the SoFi share price, it has prompted a Wedbush analyst to downgrade his overall rating and price target for this company. He literally downgraded them from an outperform rating or a buy rating to a neutral rating, also known as a hold rating, based upon their full year guidance, which quote unquote was only raised modestly, end quote. And I think that's absolutely ridiculous. The fact that they are increasing, stealing market share, growing revenues, growing EBITDA, despite the negative macro macroeconomic environment we are in is extremely impressive. But I like to give you all both sides, both the bearish and the bullish, the positive and the negative regarding this company. So let's hear what this analyst has to say. And he says, and I quote, "We fear that when SoFi starts selling loans again, there could be a material negative impact on the fair value of the loan portfolio." He goes on to say, "We believe SoFi not selling loans in Q1 could imply that gain on sale margins aren't trending at similar elevated levels to those generated last year, or that the market for loans may have weakened," end quote. And he does have a good point here. However, this is just temporary volatility that we should have already incorporated in our price targets and price predictions. This is not something that came out of the woodwork or was unexpected. So the fact that he decreased his buy rating to a hold rating or an outperform rating to a neutral rating, as well as his price target from $8 down to $5, to me is a little hasty. And I think SoFi will impress come year end, especially once they become GAAP profitable. Now let's discuss the future of SoFi Technologies throughout the rest of the year. Some investors are thinking literally about selling all of their banking institutions and banking stocks. But like this author, and I agree with him, don't be too hasty to do this. If anything, find fundamentally solid companies and buy them at a discount. This is how you create margin and profits and grow your value over the long term. You identify companies who have a great growth runway, who are very stable, resilient, and safe. You invest into them on weakness, and then as they become stronger, and once they bounce back and their share price goes up, you make money. SoFi Technologies right now is poised to come out ahead of their overall competition, especially as these uncertain times continue to try to pass us. The United States economy is bouncing back in some regards, and this is only set to strengthen banking institutions as the economy gets back on its feet. Now, despite this volatility and a lot of drama which is happening in the bank space, consumers want peace of mind, which is why SoFi Technologies offers up to $2 million worth of FDIC insurance, which is far greater than the industry standard of only $250,000 worth of protection per account. On top of that, SoFi checking and savings accounts offers direct deposit members 4.2% in their annual percentage yield, meaning that these customers are growing their money just by saving it, which is far more competitive than the majority of other banks on the market right now, considering that this is 10 times the industry average. So that's another huge competitive advantage for SoFi. Also, as much larger banks are going out of business, some of them are deciding to identify and try to identify banks who are fundamentally solid, resilient, and safe, such as SoFi Technologies, so SoFi's overall deposits are increasing, which we saw in their Q1 report. So with the combination of their safety, assurance, FDIC insurance, their monetary policies, and their phenomenal APYs on their checking and savings account, SoFi Technologies is benefiting greatly. So it's not fair to assume that all banking stocks right now are toxic in 2023, and SoFi seems to be able to bounce back stronger than ever once this overall volatility blows over. The author believes that this stock is a must-own for future thinkers and investors. However, I would say that it would depend. Clearly, this company is not going to be great for every single portfolio, especially if you're not in a position to take on risk, or if you are already overexposed to SoFi Technologies more than a 5% portfolio allocation. You should consider proper risk management policies, which would encourage you to diversify your overall holdings into other companies. However, at the end of the day, SoFi Technologies is still a phenomenal company to hold. They have a great growth trajectory ahead of it. You have multiple catalysts coming up for this company, including them having a partnership with Expedia and becoming GAAP profitable at the end of the year. And overall, buying this company while it's cheap below $5 could be a great opportunity for you to build wealth over the long term, as long as you don't overexpose yourself to this company and practice proper risk management. So with that being said, I would love to hear your thoughts down below. Don't forget to go and annihilate that like button right now. Don't forget to become a member of this channel for as little as 99 cents to support me personally, so I can continuously make videos just like this for you. Subscribe if you are new, and I'll see you in the next YT video.